Danny from Wicked Cool Finance here. Please subscribe to my channel and like this video. It's going to be a good one. Now, what ultimately makes the stock market go up? It's pretty simple. It's just a couple of sentences. Let's dive right into it right now. What makes stocks go up is the expectation and eventual realization that earnings for a company will rise. Now, does that clear everything up? Is that clear as mud? Well, I'll tell you what, let's clear it up, and we'll do that by telling a little story about Amazon.com. Now, make sure you stay towards the end of this video, because the second half of this video, you're going to get a bonus, and that bonus very well could make you a lot of money, save you a lot of money, and it's pretty cool. All right. Now, first of all, I'm going to throw out some numbers here in a second, and make sure you understand that these numbers are as of the filming of this video. What are earnings? Well, earnings are companies make things. They make things like this shirt. And after they make the shirt, they sell it in a store and they generate revenue. After they generate revenue, they have to pay for the cost of goods sold. For this shirt, the cost of goods sold is the fabric. And then you've got operating expenses, things like rent. And then, of course, you have to pay your taxes, and you have to pay sometimes interest on your money. But after you earn the money and you pay all those expenses, then you have what is called earnings. Okay? Now, back in 1994, there was a guy named Jeff Bezos. Jeff Bezos created a company called Amazon. I bet you've heard of it before. Jeff in 1994 went to a bunch of banks and he borrowed a whole bunch of money so that he could start the company. Actually, when Amazon started, all they did was sell books. Now, of course, Amazon is this massive, worldwide, diverse company. But in 94, they only sold books. Anyway, he borrowed money and began the company. The company grew and grew and grew. But believe it or not, Amazon they didn't have any profit. They didn't have any so-called earnings. And by the way, earnings and profit are basically the same thing. They didn't have any earnings until the first quarter of 2001. So we started the company in 1994 and didn't really make any money until 2001. Isn't that amazing? Well, Amazon has had its ups and its downs, but for the most part, it's done pretty doggone good, as we know, over the years. Actually, in 2022, they had a little bit of a hiccup. They actually lost money in 2002. Why did they lose money? Well, they lost money for a couple of reasons. Number one, a few years previous to 2022, they made a very, very large investment in an electric truck company called Rivian. You probably seen those trucks out on the road. Well, Rivian didn't do very well, and they ended up losing the vast majority of that investment in 2022. Also in 2022, if you remember, that was just at the end of the pandemic. And Amazon did really, really well during the pandemic because people didn't want to go to the store, and so they bought stuff over the internet, and Amazon, of course, flourished. And Amazon assumed that they would just continue flourishing, and so they put a lot of money into additional operations to make sure that they could handle that growth. And then as we got to 2022 and 23, things started to slow down. And so Amazon had a little bit of a stumble and lost money in 2022. But today they're back at it and they're doing extremely well. Well, so when it comes to earnings, companies sometimes make money and they lose money, but it is that ultimate expectation and eventual realization that they will increase their earnings. And of course, Amazon did that, and Amazon stock has gone through the roof. All right, is that the end of it? Are you ready to go buy stocks? No, you're not, because how do you know if a company is expensive or not expensive? Because you may invest in something like Amazon invested in the truck company Rivian, and they lost all their money. Well, I'm going to give you, here's the second half of this video, and here's the trick. It's called the PE ratio. If you want to know if a stock is expensive or not expensive, one simple trick is to look at the PE ratio. That is also better described as the price to earnings ratio. Now let's bring that home. Let's make it real simple, okay? Let's imagine that you were going to buy a company, and that company today made $1 million. How much would you be willing to pay for that company? Would you be willing to pay $1 million? Well, they wouldn't sell it to you for less than $1 million if they're making $1 million. Why would they do that? All right, so the company's making $1 million. Would you be willing to pay $2 million? Would you be willing to pay $3 million? Well, let's say you paid $3 million, okay? 3 would be the price. So it's price to earnings. Price divided by earnings gives you the PE ratio. So let's say the price was $3 million and the earnings were $1 million. What would the PE be? 3. Now, let's go further. Would you be willing for that company that was $1 million? Would you be willing to pay $190 million for that company? Probably not. Okay. Well, let's turn that into a real life example. Let's talk about a company that you're probably familiar with today as well, and that company is Tesla. Believe it or not, Tesla's price to earnings ratio is 190. Okay? Well, does that make any sense? Well, Tesla right now is making about $25.7 billion a year. But the company is valued at $1.16 trillion. Does that make any sense? Well, that's kind of complex. Let's just keep it simple, okay? And the simple thing is, if you were to buy a company that had $1 million in earnings, there's no way you'd be willing to pay $190 million for a company that makes $1 million. But that's where Tesla is trading. Tesla's price to earnings ratio is 190. That just seems kind of crazy to me. But then again, I'm not here to say don't buy Tesla. I'm not here to say buy Tesla. I'm just saying be careful, and that little price to earnings ratio thing is a great way to figure out if a company is expensive or cheap. But it's not the end of the world, because a company may be cheap, but it may not have a very good product. Now, there's a guy, one of the most famous investors in the world today. His name is Warren Buffett. Warren Buffett always says, buy things that you know, buy things that you understand. So let me give you an example. One company that I know and I think I understand is a company called General Motors, GM. What does GM do? Well, GM sells Buicks, Cadillacs, Chevys, and other things. Is GM a good company? Well, I think it's pretty good. But who knows? But the one thing I do know is that GM's price to earnings ratio is not 190. GM's price to earnings ratio is only 7. So when it comes to buying stocks, don't just look at the price. If the price of a stock is $1,000, its PE may be 2, and that would be cheaper. On the flip side, the price of a stock could be $3 and the PE could be 200, and that would be crazy. So be careful. Now, folks, please like this video, please subscribe to my channel, and look down below and see my past videos, and I will see you on a future video.